Hello, welcome. This is SmartHelping.com financial model slash simulation. Here we're going to go over the upgrades and full auto repair shop slash tire shop financial model. I'll go through each tab, explain how the logic works, and all the summaries. Don't forget to subscribe, like the video. So we go first tab, global control. Well, I guess there's the index tab, which I will update with all these new upgraded tabs, but this will have a tab and a tab description. If we look at global control, so here you just define some general things like the name of the company, the launch year, end month, if you're including terminal value or not, and if so, what's the multiple? It's going to do EBITDA multiple here. Any debt funding is going to come in here, and then any remaining funds the model solves for, this is going to be the minimum equity required to be contributed. Cap table is going to define how much comes from insiders versus outsiders. We also have some tax rate stuff here if you want to show taxes, and then we've got all our sanity checks right here. These always should be all zeros. Revenue assumptions, this is the main part of the model. This is how you're driving revenue, and I've done so 3 sales channels. You can make money through selling tires, parts and accessories, and repair work. So for tire sales, you can define up to 10 tire brands, the months you plan on starting to sell each, the average sale price, the average cost, and this shows you your profit per tire and profit margin. You can also define the expected monthly tire sales of each type in each of the 5 years. Parts and accessories, same kind of logic. You've got all these different parts and accessories here. Start month, average sale price, average cost of goods sold, and then profit per sale, profit margin, and expected units sold per month in each year. Repair work is a little different. So I did 12 repair types, start month, and then here we have price you're charging per hour for labor, and then the total labor hours for each repair type per month, and then each year. So that's how you're driving revenues. Cost assumption is pretty simple. We've got a bunch of fixed costs here, up to 129. You can define each one, the start month of that, and the monthly cost in each year. And again, I've updated the year to 2022, so I'll just update this real quick to 2022, which is fine. Startup costs, these are just one-time costs that go into the startup of the business. It could be, usually these would be things like maybe build a website, you might have some R&D, reserve, maybe some legal costs. Cap table here, you can define some total outstanding shares, percentage of each share type, who's contributed what money based on the minimum equity needed. You could define that here. If you don't want to define it anywhere, this will just be the overflow, which will just pull all into here. You can define the percentage of shares of each type. You get a fully diluted ownership share here for outsiders and then insiders. And then we've got a distribution schedule for each row individually and in total, as well as the internal rate of return. And again, those will all update based on the shares percentages here. CapEx, first row is always for building. If you're going to buy buildings, useful life, depreciation, the purchase month, and then if you're going to include terminal value, you can put a value here at the end for that. And then the rest of these you can define as the type. These will usually just be vehicles or equipment items. The cost basis, useful life, month of expenditure. And then this value of sale is going to come based on any percentage here, less than 100%. Will go to CapEx, and that'll be a tax thing. If you're not going to apply taxes, it doesn't matter. You just put 100% here, and it'll just flow through. Debt schedule. This is going to be, you can define the terms of the loan. If you're going to borrow any money to start for the startup costs, this is basically be an SBA loan. And you can put the terms in here, month of that you're going to take the loan out, and then If you include terminal value, this will automatically be paid back on the end month. Inventory, this is going to be for tires and parts and accessories, and you can define how frequently you buy inventory. So if you do it every 4 months, then you can see here 1, 2, 3, 4. Now buy it again 1, 2, 3, 4. If I put like say a 3 here instead, you can see 1, 2, 3, 1, 2, 3, and it's just going to be based on the expected cost of goods sold for the period you're buying inventory for. Now that will translate to the balance sheet as well. You can see here every 3 months you're zeroing it out basically, and it's based on the inventory or expected cost of goods sold for the period, and that will be reconciled in the cash flow statement. So if we go to the financial statements here, income statement, you've got revenue, cost of goods sold, OPEX, um, EBITDA, interest, depreciation, any extraordinary income or net gain or loss from the sale. This will only be on the end month. Then you've got taxable income, taxes, net income. And you don't have to show taxes again if you don't want to, just zero it out. It's no big deal. Or if you don't want to show taxes on the sale, you can just zero out these rows here, on here, and on the income statement. Now, if you do that, you're not going to balance on the balance sheet. You would probably actually have to just put either just don't include terminal value if you don't want to see that, or hit a 0 multiple. So if you did 0, hit no here. Yeah, then you just wouldn't have any terminal value included in the forecast. Balance sheet, you've got cash and inventory as your current assets. Long-term assets based on the fixed or the CapEx schedule. Accumulated depreciation. Total assets. Liabilities, we just basically have the loan. And then equity, we've got equity contributed, retained earnings. And then if you add everything up, the total assets always will equal total liabilities plus owner's equity. And there is our check there for that. Balance sheet does the same thing, but just on an annual basis. Cash flow statement does the cash flow from each operations, investing, financing. You can see here has the purchase for inventory. So there's where we're reconciling the actual cash balance or cash flow per period. Cash flow statement annual. Executive summary shows some high-level items, revenue from each revenue channel, cost of goods sold, selling, general administrative costs, total expenses, EBITDA, debt service coverage, and then other cash flow items, total cash flow post-tax, and then cash position, as well as a sanity check, some visuals on revenue by type, EBITDA, return multiples, IRR, equity multiple, ROI for the project and insiders and outsiders. You've also got discounted cash flow analysis and some checks here. So this is showing total cash available to distribute, total cash required up front, the internal rate of return of the project, the net present value of the project, and then same thing for investors and owners, as well as a nice visual on them. We've got more visuals here, expense summary by cost, and then parts and accessories, tire costs, revenues by type, cost by types over the year, cash flow, cumulative cash flow. Here you can see where your break even is on equity, and the entire sales by type per year. This is another valuation. This is the present value of the future cash flows. So enterprise discounted cash flow analysis, or discounted cash flow value, or enterprise value. So we're just discounting the future cash flows and the terminal value. Monthly detail is where all the assumptions roll to, and this is where you can find details on the sales of each type, the revenue, the cost, gross profit for repair, tire sales, parts and accessories, uh, total revenues, cost of goods sold, gross profit, fixed costs, debt payments, and then other cash flow items. You can also hide these rows if you just want to see high level. Annual detail does the same as monthly. And that's about it. So if you're thinking about starting an auto repair shop, this is a nice comprehensive model. You can fill it out based on your own assumptions and strategies and see what the startup costs look like, the burn, and expected performance and possibly potential exit. Alrighty, that's all I got for you. This template will be $125. You can find it in the description box below, or it'll be uploaded to the vendor sites as well. I'll see you guys on the next one.